Hello and welcome to this video on financial plans and considerations for saving taxes for salaried employees. As a salaried employee, one of the most important aspects of managing your finances is to minimize your tax liability. In this video, we'll take a look at some financial planning strategies that can help you save on taxes and boost your savings. The first thing to consider when it comes to saving taxes is to take advantage of all available tax deductions and exemptions. When you earn income, you are required to pay taxes on that income to the government. However, the government also provides certain tax deductions and exemptions that can help reduce the amount of taxes you owe. Tax deductions are expenses that you can subtract from your taxable income, which reduces the amount of income that is subject to taxation. For example, if you earn $50,000 per year and you have $10,000 in tax deductions, you would only be taxed on $40,000 of your income. Some common tax deductions include contributions to retirement accounts like 401(k) and IRAS, mortgage interest, charitable donations, and certain medical expenses. Tax exemptions, on the other hand, are deductions that are not subject to taxation at all. For example, if you have dependents, you may be able to claim them as exemptions on your tax return, which reduces your taxable income. It's important to note that tax deductions and exemptions vary depending on your specific situation, such as your income level, filing status, and other personal factors. So it's important to consult with a tax professional or use tax preparation software to ensure that you're taking advantage of all the deductions and exemptions you're eligible for. Contributing to a 401 plan is a great way to save for retirement while also reducing your taxable income. Contributing to a 401 plan is one of the most effective ways for salaried employees to save for retirement while also reducing their taxable income. This is because 401 contributions are made on a pre-tax basis, meaning that the money you contribute is deducted from your taxable income for the year in which it is contributed. For example, if you earn $50,000 a year and contribute $5,000 to your 401, your taxable income will be reduced to $45,000. This means that you'll pay less in taxes for the year and have more money in your pocket. Additionally, the money you contribute to a 401 plan grows tax-free until you withdraw it in retirement. This means that you won't pay taxes on the money you contribute or on the investment gains until you withdraw the funds in retirement, which can help you maximize your retirement savings. Another benefit of contributing to a 401 plan is that many employers offer matching contributions, which can further boost your retirement savings. For example, if your employer offers a 50% match on the first 6% of your salary that you contribute to your 401, and you contribute $5,000, your employer would contribute an additional $1,500. This is essentially free money that you can use to save for retirement. It's important to note that there are limits to how much you can contribute to a 401 plan each year. For 2023, the contribution limit is $19,500, and for employees age 50 and over, there is a catch-up contribution limit of an additional $6,500. Similarly, contributing to an IRA can also help reduce your tax liability. Contributing to an individual retirement account is a great way to save for retirement while also reducing your tax liability. When you contribute to a traditional IRA, you are able to deduct the contribution from your taxable income, which can help lower your overall tax bill. For example, let's say you earn $50,000 a year and contribute $5,000 to a traditional IRA. When you file your taxes, you can deduct that $5,000 from your taxable income, which will lower your taxable income to $45,000. This means you will owe less in taxes overall, and you will have saved money for retirement at the same time. It's important to note that there are limits to how much you can contribute to an IRA each year. In 2023, the maximum contribution limit is $6,000 for those under the age of 50 and $7,000 for those 50 and older. Additionally, there are income limits for deducting IRA contributions. If you make too much money, you may not be able to deduct your contributions from your taxable income. However, even if you are not eligible for the tax deduction, contributing to an IRA can still be a smart financial move. The money you contribute will grow tax-deferred until you withdraw it in retirement, which can help your savings grow more quickly over time. Another tax-saving strategy for salaried employees is to take advantage of employer-provided benefits like health insurance and flexible spending accounts. One of the tax-saving strategies for salaried employees is to take advantage of employer-provided benefits like health insurance and flexible spending accounts. When it comes to health insurance, if your employer offers a group health insurance plan, you may be able to save money on your taxes by enrolling in it. This is because the premiums you pay for your health insurance are generally tax deductible. If you opt for an employer-provided health insurance plan, the premiums are typically deducted from your paycheck before taxes are taken out. This means that your taxable income is reduced by the amount you pay for your health insurance premiums. Another way to save on taxes is to take advantage of flexible spending accounts offered by your employer. FSAS allow you to set aside pre-tax dollars to pay for eligible medical expenses like deductibles, co-pays, and prescription medications. By contributing to an FSA, you can reduce your taxable income and save money on taxes. For example, let's say you earn $50,000 per year and contribute $2,500 to your FSA. Your taxable income would be reduced to $47,500, which means you'll owe less in taxes. Plus, because you're using pre-tax dollars to pay for eligible medical expenses, you're effectively getting a discount on your healthcare costs. It's important to note that there are limits to how much you can contribute to an FSA each year. In 2021, the contribution limit for FSAS was $2,750, and it's subject to change each year. It's also important to plan your contributions carefully, as any money you don't use by the end of the plan year may be forfeited. Next, consider timing your deductions. When it comes to filing your taxes, you have two options for how to claim your deductions. You can either take the standard deduction or itemize your deductions. The standard deduction is a fixed amount set by the government that you can deduct from your taxable income, regardless of your actual expenses. Itemizing your deductions, on the other hand, means adding up all of your deductible expenses and claiming the total amount as a deduction on your tax return. If you are close to reaching the standard deduction limit, it may be beneficial to itemize your deductions instead. This is because if your itemized deductions add up to more than the standard deduction, you can reduce your taxable income, and therefore, your tax liability. For example, let's say that you are a single filer and the standard deduction for 2023 is $12,950. If your total deductible expenses, including mortgage interest, property taxes, state and local income taxes, and charitable contributions, add up to $12,000, you may want to consider itemizing your deductions instead of taking the standard deduction. By itemizing your deductions, you can deduct the entire $12,000 from your taxable income, which will lower your tax bill. However, it's important to note that itemizing your deductions can be time-consuming and requires you to keep accurate records of all of your deductible expenses throughout the year. It may also not be beneficial if your total deductible expenses are close to the standard deduction limit or if you don't have enough expenses to itemize. You may also want to consider tax loss harvesting, which involves selling securities that have decreased in value in order to offset gains from other investments. This can help reduce your tax liability on capital gains. Finally, don't forget about tax credits. Tax credits are even more valuable than deductions because they reduce your tax liability dollar for dollar. For example, the Earned Income Tax Credit is a credit for low to moderate income workers that can be worth up to $6,728 for a family with 3 or more children. In conclusion, there are many financial planning strategies that salaried employees can use to save on taxes and boost their savings. These include contributing to retirement accounts, taking advantage of employer-provided benefits, timing deductions, tax loss harvesting, and taking advantage of tax credits. By following these strategies, you can reduce your tax liability and keep more money in your pocket. Thank you for watching, and if you have any questions or comments, please leave them below.